Well, for the last 3 weeks, I've been travelling in the east coast of the US, Europe, including Paris and Frankfurt, and an extended time in London, visiting with officials and customers. I think there's some major themes that I've really come back with, and the major one relates to the imbalances that the post-COVID period has provided and how that's affected monetary policy around the world. So we've seen these big imbalances emerge. The first one, of course, is a big gap between the demand and supply of labour, with the demand for labour being boosted by stimulus, as well as the reopening of economies, and the supply being restricted by early retirements, say in the US, or border closures in Australia, Canada and the UK. So these big imbalances in the labour market, of course, have meant that the labour market has remained stronger for longer than authorities were expecting. The second imbalance is the accumulation of savings. So people were locked up, they were given money by the government. In many countries, the case was more money than they would normally have been earned during that period. And they weren't able to spend that money, and they accumulated excess savings. Now, those savings, of course, are acting to buffer spending in particular economies, but also it's acting to support asset markets. So in the case of the US, we've been surprised that the US market has held up for a lot longer than we expected, given the 500 basis points of tightening we've seen from the Fed. In the case of other countries, we've seen that housing markets have started to recover, despite the fact that central banks have raised interest rates so far. The third one is fixed rate loans. So we've seen a much higher proportion of fixed rate lending in these countries, Australia, Canada, UK. And that channel through household balance sheets, through the cash flow of households from monetary policy, has therefore been dented. And so it's meant that monetary policy hasn't been as effective as you would have expected with such a high proportion of fixed rate lending. Now, of course, that's going to change. In the case of Australia, it's changing immediately, as the fixed rate loans in Australia have been 2.5 to 3 years in length. But in other countries, the fixed rate loans are longer. Of course, in the US, they're 30 years. So the Fed policy has no real direct impact on households through that particular channel. But in other countries, say 5 to 6 year fixed rates, they've been reflecting the fact that even before COVID, interest rates were very low. So these fixed rates have also been denting the impact of monetary policy. So what it's meant is that, say, a few months ago, the market was expecting that the Fed was going to start cutting rates by July, August this year. And of course, now the market is questioning whether they'll be able to cut rates at all this year. The Bank of England thought they'd be on hold by now, but now they're projecting a significant additional number of rate hikes. In Canada actually went on hold some months ago, but now they've restarted their cycle. And of course, in Australia, we've seen 2 surprise rate hikes in May and June. The cash rate is now up to 4.1%. And the rationale given by the Reserve Bank governor for that surprise rate hike in June was all around his concerns that the wage price spiral was not as under control as he expected, that inflationary expectations remained elevated, and there were risks around that people were generally feeling more confident about wages growth, as we saw the 5.75% increase in award wages and the 8.75% increase in the minimum wage. That encouraged people's expectations about wages. Also concerned about the sharp rise in unit labour costs. This is the actual cost to businesses of labour, and if labour's producing less output than they had in the past, then wage pressure really does come onto that inflation picture. So those two factors have really changed the Reserve Bank's balance from our perspective. Instead of trying to maintain most of the benefits on the labour market from the post-COVID developments, I think now it's very much about we have an inflation challenge and we have to deal with it. So when we saw those statements, we thought, well, even though the consensus was that they would wait until August for the move, we really thought that why would you wait when you've got such a change in approach? And of course we saw that and so we raised our forecast for the next rate hike being July. We said there was a significant risk around August, and that significant risk has actually materialised last week, when we saw 76,000 new jobs in the labour market report. We thought that there was going to be a major seasonal adjustment there. So we thought 40,000 jobs, which was almost double consensus, given that we saw a small negative in April. But that 76,000 is not just a seasonal adjustment. That's indicative that the labour market remains very strong. And indeed, over the last 12 months, the pace of new jobs growth is still averaging around 36,000. So despite the 400 basis points of rate hikes from the Reserve Bank, the labour market still remains very tight. And that is signalling these wage pressures that the Reserve Bank must be worried about. For that reason, we now believe that they will also raise the rate again after July in August to a peak of 4.6%. If you think about what the Reserve Bank will be facing in August, we expect they'll still be facing underlying inflation above 6%. They'll be very close to looking at full employment, and policy at 4.35% will be about 125 above neutral, compared to, say, in the case of the US, where we believe policy is nearly 300 basis points above neutral. So the policy stance isn't as restrictive as it is in other countries, and that's why we think the RBA will move to a 4.6% rate hike. If we go that far to 4.6%, then we have to reassess the timing for the first rate cut. We did have that timing in February next year. We're now expecting it'll be in May. Now that rate cut will be sorely needed, but we don't think the authorities will feel comfortable enough around these inflation risks to cut as early as February. What does that mean for growth? Back in March, when we expected the rates to peak at 4.1%, which was above the consensus view, might I add, we also thought that growth would be a very weak 1% in 2023 and 1.5% in 2024. That was below consensus. The Reserve Bank had a number of 1.6%, for instance, in 2023. But given that we now have a much higher peak for the cash rate, we have to reassess our growth forecasts. And we've decided that we think growth now in 2023 will be only 0.6%, and in 2024, 1%, down from 1.5 respectively. The key driver of this weakness is the consumer. We're expecting consumer growth to remain at about 0.3% this year and only 0.6% next year. And indeed, in the first half of next year, we think we'll see a negative on consumer spending, with the second half looking better in response to those rate cuts that I referred to before and the stage 3 tax cuts coming in the second half of 2024. Of course, with population growth at 1.8% this year and 1.6% next year, and growth of 0.6% and 1%, we have a per capita recession in both 2023 and 2024. Do we have a technical recession, which means 2 negative growth quarters? Not. We're expecting that you will see a negative in the first quarter of next year when you see the accumulation of all these fixed rates moving onto floating rates, the effect of the RBA rate hikes really starting to impact upon the household sector, and of course the effect of rising rents also impacting that household sector. The other issue that we can't leave out of this thinking is that the Reserve Bank was quite unnerved by the recovery in the housing market in May, with house prices rising by 1.4%, despite the fact that there'd been a surprise rate hike in early May. Now, what we've seen in the early stages since the June rate hike is that the housing market remains resilient. In our consumer sentiment survey last week, we pointed out that our question, what's the outlook for house prices over the next 12 months, actually held steady despite the fact we'd had another interest rate increase. And we've seen encouraging news around our auction clearance rates as well. So all of that suggests that we will see that rate hike, we will see much weaker growth, and indeed, whilst we're not predicting a technical recession, we've only got 1 quarter of negative growth. It's certainly not going to feel great in 2023 and 2024. Thank you.